So looking at silver, now we view the same actors' footprints in silver futures because we look at gold and we look at it's the same actors in silver, and it's the clue. It always provides us the clue to seeing a turnaround in the heavily officially intervened gold market, which is much harder to read. And as is always the case, the easier to read smaller silver market, which was reported to have bottomed, which we reported had bottomed last Tuesday the 15th, and that was at 22,265. The same actors' footprints in gold are following through and following the silver rally.
In recent discussions, Andrew Maguire, a notable figure in the precious metals sector, has been shedding light on several critical developments that have the potential to impact the gold and silver markets, as well as the broader global financial landscape. Andrew highlights a turning point in the silver market occurring on last Tuesday, with silver hitting $22.265, mirroring patterns seen in gold trading and indicating a potential rally. This aligns with silver's recent surge to a 3-week high amid increased short covering and perceived bargain hunting. Andrew suggests that as silver's upward momentum reverses, a rebound could drive it past $26, triggering buying from those covering their short bets and potentially pushing it into the $30. A recent 7.95% gain up to August 23 indicates silver's recovery from a month of losses and signals the end of prevailing bearishness, as noted by Nitesh Shah of WisdomTree. Shifting focus to the gold market, Andrew highlights the trend of central banks from several countries actively acquiring gold, contributing to a potential shortage. According to information from the World Gold Council, 8 central banks, including Poland, China, Singapore, Russia, Iraq, India, the Czech Republic, and the Kyrgyz Republic, increased their gold purchases in May. This trend indicates a growing demand for the precious metal. Just before you watch the Andrew Maguire's interview and learn more about market trends, consider subscribing to our channel and give this video a big thumbs up. Moreover, Andrew points out a disconnect between the paper gold market and the actual gold market, attributing this disjunction to the Federal Reserve's involvement in trading paper gold that lacks physical backing. It's noted that the Federal Reserve Bank of New York functions as a custodian for gold held by entities such as governments, central banks, and international organizations. This situation underscores the intricate dynamics between the paper and real gold markets, shaped by both market forces and institutional actions.
With all the silver longs rinsed and any remaining sticky market longs actually hedged, any fresh selling has consisted of naked short supply, which is once again building bubble territory not seen since the March 10th $20 rally from the March the 10th at $20, and it rallies significantly from that level. Similarly, once silver commences its unwind, there's sufficient spec wrong footing for a coiled rally into the 26s without much opposition, and then it will start to threaten very large short stops sufficient to run silver into the 30s. So, as is always the case, momentums in either direction are always wrong at both ends. Silver best evidences this, and while through the learned behavior, we expect to evidence these blinkered momentums to from time to time continue to take the house bid pulling bait. In other words, they don't go short, they just pull a few bids because they're market makers and they race in. And what can't be ignored is that the Fed, the only central bank, naked short paper gold, is joined at the hip, deeply wrong-footed versus these global physically settled, versus the globally physically settled gold market. Gold purchased by the global south, central banks are off-grid, meaning no Western central bank monetary gold is even required to be reported. This drain of bullion nevertheless eats into just one singular aggregated source of global supply, physical supply. But even when this published on record central bank gold purchasing tonnage figures, when they're finally reported next quarter, it will evidence the largest quarterly central bank demand of 2023. And furthermore, while 2022 evidenced the largest central bank gold buying since Nixon closed the gold window over 50 years ago, upcoming published 2023 central bank gold demand is estimated to exceed last year's record central bank gold purchases by at least a factor of 2. And if this month is anything to go by, possibly times 3. Whereas off-record liquidity providers expect multiples of these record central bank purchases. This is a huge drain of physical. So under the smoke and mirrors Fed-driven COMEX intervention action, this growing disparity between the gold that Fed has been naked short selling, this is paper gold against where they've been selling against the dollar, naked because the dollar that offsets the sale of this gold is just literally borrowed paper gold. And it comprise of nothing but freshly printed fiat-backed dollars. So that's your hedge. And while the infinitely printed dollar side of the trade is cash settled inside the casino, no physical gold ever gets delivered. The only traders not seeing the resulting paper to physical disconnect is forcing the physical bullion to be delivered outside the casino. And the only ones are the siloed COMEX traders relied upon by the House to dance to their tune. However, it's not so for the unleveraged global market participants who are capitalizing on this disparity. Namely, the outflow of real gold, physical gold bullion that is ultimately underpinning these leveraged naked gold, short gold bets. And this has placed the Fed, and I keep repeating this, the only global central bank naked short gold in a position that is even more precarious than when the Bank of International Settlements had used the very same cover of Fed shorting gold, this ill thought through Fed 2022 gold market interventions. So it enabled the Bank of International Settlements to cover all of their remaining short bets. That was back in November 2022.
Andrew highlights that the BRICS countries are actively collaborating on the development of a fresh currency intended for trade within the alliance. Notably, Russia is taking a pioneering role by employing blockchain technology to explore the digital trading of gold. In a notable partnership, the Central Bank of Iran is reportedly cooperating with Russia to establish a novel cryptocurrency underpinned by gold reserves. According to reports from the Russian news agency Vedomosti, this collaborative effort aims to introduce a token of the Persian Gulf region, which holds potential as a means of facilitating international trade transactions. On a related note, the Moscow Exchange is positioning itself to introduce perpetual gold futures trading in the imminent future. Andrew elucidates that this emergent currency system is intricately tied to what is termed the two-stage commodity basket structure. Let's get back to the interview.
The new method of settlement in the international trade between BRICS countries. Now, the mainstream media have been desperately trying to play this down. And we delved into this much deeper in our last episode. But in summary, the new currency unit he outlines creates a sanction-proof mechanism to settle trades between participants, but it's being launched in parallel to existing methods. Now, while this currency ultimately competes with the dollar, the immediate focus is not on undermining the dollar, but running alongside it. Now, the mainstream media just don't get this. As far as their narrative goes, you are either with the dollar or against it. Hence the bearish narrative around the traction the BRICS currency will gain. And as Bloomberg put it on Monday morning, they called it a possible threat to world order. Now, isn't it funny? On Monday morning, I heard that as soon as I switched on Bloomberg. And then since then, they haven't talked about it. And I think they were probably told to mute that line. Now, what is unreported is that Russia began trialing physical gold on the trustless blockchain back in January. And the digital gold grams required to power the upcoming gold-backed digital currency is now well proven and is ready to handle the hundreds of tons required to monetize this currency. Now, subscribers will recall that Sparebank was sanctioned to begin trialing this digital-backed gold on the Stellar blockchain at the open of January trading. We drew attention to it. And we have reports that this element has become part of the process and is now fully functioning. And as we've just drawn attention to, the proof's in the pudding, and it's no coincidence that in spite of weakness in the ruble, spot gold consistently trades tick for tick at a $2 to $3 premium to local London gold. And the Moscow physically settled futures market is matching an average of a $3 premium over December COMEX futures. Interestingly, today, just before the rally, we saw a $29.50 premium in the Moscow futures versus the December contract, which was smack in the middle between the February contract and the April contract. So they were clearly significantly betting on higher prices. So why is this happening? Why are they bidding more? Why is the spot market bidding consistently? So as to attract gold sellers seeking a better price than they're getting in London. And whilst while these central banks are loading their coffers to back this multipolar new world economic currency, Russia is building their bullion reserves. It's so clear. And this leads into Glavznev's two-stage commodity basket structure, which we did outline in more detail in the last episode. And these two currency baskets have two separate purposes. The first one is consisting of national currencies, and that was similar to the SDR, and that encompasses kind of a balanced basket weight formation. But the major focus is on the second basket, which is really the key component, and that comprises of 20 of the most liquid commodities from oil to grain, including this gold anchor. Now, the most liquid commodities, including gold, of which Russia produces all of these commodities, which in aggregate is going to provide a stable index to benchmark a new world currency, such as would suit the BRICS Development Bank, all seamlessly settled on the trustless blockchain. Now, the New World Economic Order's settlement currency addresses all important liquidity. Following the BRICS Plus summit, the currency and innovation infrastructure meetings move over to Moscow on Monday. And among the BRICS participants, some 30 countries from Asia and the Middle East will attend. So as far as gold and silver is concerned, at the margin, this price-setting platform will pose serious competition against the COMEX, CME, LBMA monopoly.
As these significant developments unfold in the precious metals sector and global financial landscape, how might these evolving trends in silver, gold, and the emergence of new currency systems shape the future of global trade and financial stability? Share your thoughts in the comment section. If you liked the video, don't forget to subscribe to our channel and tap the bell icon so you don't miss out on our upcoming content. Surprisingly, around 89% of our viewers haven't subscribed yet. We're aiming to reach 3,000 subscribers in the next 2 weeks, and your support could make a big difference.